Today, I'm going to be talking about why you always find yourself getting stopped out by a tick, a wick, or whatever price action is going on. You always find that you're getting your stop loss getting hit and becoming liquidity prior to the move actually going towards where you originally were setting your TP. So that's exactly what I'll be talking about in the rest of this video. I'll be giving you guys specific reasons and ways to potentially avoid in the future losing money on stupid trades where you're just getting stopped out by these little wicks and for price to just go in your direction. So if you're ever having that problem, this video is going to help you find ways to resolve that problem. And also I'm going to be explaining exactly why that occurs, because a lot of people are not sure exactly why things like this occur, and that's exactly what I'll be really going into today. So without further ado, let's jump straight into it. So one of the main things, the reason why these wicks, like for example this, or these huge wicks, either they're news obviously, which you shouldn't be in a trade with typically with news, and if you are in a trade with news, you should be at, your stop loss should be moved at break even anyway, so that shouldn't be the problem, and that's not what we're going to talk about today. So we're not talking about these big wicks today. Instead, rather today, we're talking about these small little wicks that do the damage, right? Wicks do the damage, bodies tell the stories. That's how price action and candles really represent. So today we're going to be talking about these wicks that are doing the damage when you're in a trade. For instance, let's say you're short here, right, off this rejection right here. Let's say whatever your entry model is, inverse fair value gap, whatever your entry model is, let's say you enter here with this OB, and look, you get stopped out right by a tick right before, you know, price goes in your direction in favor. And situations like this is very annoying to trade, and the reason why is because you're gonna have to find a way to re-enter a trade. And sometimes, in this case, there was a way to re-enter this trade right here, right, which was perfect. But sometimes, or not always, you're gonna get this re-entry. Sometimes it's just gonna wick you out and then immediately flush down like this without any pullbacks for you to enter off, right? And that's when it gets very annoying. That's when people start FOMOing into trades with really bad risk to reward, like 1-to-1 or even lower than 1-to-1 at times. And sometimes that might not even work out either because you're entering at a bad price. Sometimes price actually will flush just for it to come back and hit you at stop loss, and you don't have much space to really manage your trade because your entry point is so bad. You have a bad price point. And so that's what we're going to be discussing today. And the main cause of this is difference between micros and minis. So for those that don't know, if you're trading futures, there's the mini contracts and there's the micro contracts, and both type of contracts are applied to the same assets and they have different charts. Now, I'm not going to say they have different charts. They have the same charts that should be correlated exactly. However, they are not exactly the same. There are very slight minuscule differences, but those slight differences lead to wicks like this that stop you out. And if you're trading Forex, it's even more apparent or prevalent, because in Forex you have different brokers providing, or different exchanges providing different data feeds, and these different data feeds provide different pricing on the asset that you're looking to trade, right? So let's say you're trading gold, there's Oanda, there's so many other things. Let's say, look, if you're trading gold, right, there's Oanda, there's Forex.com, FX, CM, Pepperstone. So if you're trading Forex, there's so many different brokerages offering different pricing and different charts at times for gold. Majority of times they should be moving the same, very closely to each other, but not always, right? Sometimes you have big wicks on certain brokers, sometimes you won't. So I'm not going to dig too deep into Forex today, but I'm just going to be digging into the difference mainly between minis and micros for futures trading, because they use a common exchange. And the thing is, even with the common exchange and it being centralized, there's still things that happen like this in terms of price discrepancy, and you can view it as the same way as basically brokers having different charts and pricing. So again, for Forex, really you can also take the advice from this video and apply it to how you trade Forex as well. So yeah, anyway, we're just basically doing this test from February 4th, which is about almost a week ago. Okay, I basically went on my chart and really mapped out everything so this video can go much smoother and faster without having to spend time and waste time talking to you guys and trying to find these things at the same time. But essentially, the reason why these wicks occur more oftentimes on the micros than the mini chart is because on the micros, price can be pushed around more easily due to less liquidity and volume. So if you look at the volume here, you can even see it. There's obviously more volume for the ES contract or ES mini contracts than the micros, than MES, right? 1.6 million versus 1.16 million. Now, I'm sure the discrepancy is going to be extremely way bigger than this. This is just the last reported volume, which is not that accurate because this is when price is basically about close. It's not live right now. But if it's live, you will see bigger discrepancy in terms of the volume numbers right here. You can see the discrepancy even more between the mini Euro USD and micro Euro USD, right? It's a pretty big discrepancy between volume and liquidity. And typically liquidity and volume, you can consider them in the same pool. Same with volatility. Usually the more volume, there's more volatility, more movement in price. And a lot of that also has to do with liquidity, right? And because of less liquidity, price discrepancies can be bigger, right? This wick can be a bigger wick than usual because it takes less money to push the market, right? If there's a pool of $100 million in minis or micros chart, which we're on right now, and one person has even 60%, obviously this is not realistic at all, but so 1% has 60 million and they buy here, it's going to create a huge massive wick in comparison to if you were on, let's say, the minis, right? The mini contract, and there was like 800 million. Then someone with the 60 million buy order is not going to make really a major difference to that market or move it much. So that's why these wicks do occur on the minis or on the micros a lot more often than the minis, and I'll be showing exactly when these occur on the charts with these examples. And also mini orders are always basically prioritized and processed in the system first before micro orders are. So there's also that slight delay that could cause things like this discrepancy in pricing. But I think the main reason is logically that price can be pushed around easier due to less liquidity on micros compared to the minis. So now that you guys know that, we're going to be going into some examples. So here, for example, let's say you took a short here, like I mentioned, right, off the OB entry model that I teach you guys here, right? And let's say you're targeting this low, which is a valid low to target, right? That's a very nice 7-minute story with the system I teach you guys. Now let's go to, what day is this? February 4th. Okay, let's go to February 4th. Right here, perfect. I drew a red line there for a reason. You can see if you're taking this short on the ES, right here, targeting that low, you can see how there's a difference here, right? There's this wick here on the right on the mini micro chart is higher than the previous stop loss, previous wick high, meaning it took people out that had their stop loss right here or right above even. But on the ES chart, you can see it's equal highs. This high or this wick here did not take out the previous high, it just made equal highs. And that's another thing I want to talk about in terms of suggestions. If you're trading futures, I'd highly recommend just giving one tick more of wiggle room, regardless if you're on minis or micro charts, because even on the minis, at times when you have your stop loss like right here, even though it's making equal highs, it technically hit your price point, and a lot of times, 9 out of 10 times, it's going to stop you out here. So I'd recommend just giving it one tick of breathing room. That's good enough, honestly. So next time you take trades, if you realize, go back to your trades and see how much you're getting stopped out. You'll find a lot of times it's by these ticks. And if it's one tick, you want to increase your stop loss by one tick or even 2 ticks. It all depends. But for me personally, if you're trading minis, I highly recommend increase it by 1 tick. And if you're trading micros, I'd highly recommend increasing it by at least 2 ticks. So this way, see here, you won't get stopped out, right? So that's one example right there. Let's find another example that I have marked out. And a lot of people don't realize this based on how more common I'd say this is, because they don't journal their trades. So if you're not journaling, you don't remember day 1, day 2, day 3, day 4. Are you going to be able to recall every trade in your brain? Not always, right? Maybe you'd be able to recall some trades, but not always every single exact trade. Here's another example. Here we made equal lows on ES. This low is at the exact same price point as this low here. Meaning, like I mentioned, always give at least 1 tick of space either way. In this case, it didn't really count as getting hit here, but technically it did. So I'd recommend, again, always 1 tick of extra space anyway. And in this case, you likely would have hit TP maybe not. So let's say your TP was farther, so you would have been fine in this trade, right? But then look on ES or MES, the micro chart, at the exact same time, 256. This low made right here got swept by a massive wick. This time it wasn't just 1 or 2 ticks. This is like multiple ticks right here. 1, 2, 3, 1, 2, 3. So 4 ticks, right? You got swept out by 4 ticks here on the micro chart. And this is something that you just can't avoid really, unless you really want to increase your stop loss by that much. But I'm just letting you guys know that these things and behaviors do exist in market, whether you like it or not. A lot of people try to pretend they don't, but they do. So you can see you would have got stopped out having your stop loss here, right? This is the micro chart. So the main thing to really avoid this, I'd say, in my terms of recommendations, is to just trade minis if you can. If you don't have the money or the account balance or margin to trade minis, then obviously just stick with micros and just keep in mind that things like this will occur from time to time, and they're unavoidable if you're trade with a tight stop loss like this, right? They're just unavoidable, and just know that this does not mean your original trade idea or direction was wrong. You can still find ways to re-enter. That's why I also teach you guys how to re-enter trades, because sometimes this will occur even on the mini chart, right? I actually found an example where the mini chart did a sweep, internal liquidity sweep, while the micro chart did not. But that is very rare, and I only found one instance of that. So I stick to the general guideline that you want to avoid trading the mini chart, or want to avoid trading the micro chart and trade the mini chart instead. It's not only do you get swept less often because there's more liquidity, you also get filled likely easier and better, and also the more important thing is gaps, for value gaps, order blocks, things like that. They're a lot easier to not only to see, but also sometimes they're a lot more accurate, right? There are times where, especially when there's low volatility, low volume in terms of a trading session, potentially, maybe you're trading Asia session, that there are certain image for value gaps that may not be visible. For example, let's say on the micro chart, but on the mini chart they are there, and so you miss an opportunity to take a trade, or you miss an opportunity to TP, right? Like for example, this is why POCs also exist that I teach you guys in the course. These POCs, sometimes on, for example, the micro chart, you hit the POC. Oh no, on the micro chart, for example, you hit the POI. Let's say origin here, and your long entry hits TP at the origin. But then on the mini chart, price only goes towards the POC on the mini chart, and then it reverses. So there's small discrepancies as well. So keep that in mind. Not only does this apply to TPs, but also stop losses and things like that. So that's another example right there. Here's another example right here as well. You can see we made perfect equal lows here, right, on ES. So again, try to give yourself at least one tick of wiggle room if you're trading ES, unless you don't care about this and you don't mind re-entering. But me personally, I'd rather not go into drawdown, or not even drawdown, but rather just be able to basically let my trade run without me having to actively manage it too much, because not only is that time consuming, but also a lot more effort when you know you can just, when you have a solution to fix that problem, right? Just one tick more, right? It doesn't hurt. It won't hurt you. Right here. One tick more off this IFVG entry model right there, 4.5 risk reward. Now again, if you go on the ES micro chart, if you take the exact same trade, you get stopped out right here by a tick, right? This wick right here stopped you out. You can even check the time, 4:46. Where's the wick? 6 o'clock. Where's the wick? Let's see right here. The wick is here. So you can see how the wick placement on the mini chart is a lot more accurate and less volatile, because there's more liquidity, so price won't fluctuate as much than the mini or than the micro chart, where boom, big wick, immediately stops you out. And that's also 6 o'clock, which is right after spread hours, so you probably should not even be holding this trade anyway. But these other examples are not within that time, so keep that in mind. Here's another example right here, where actually this is one of the rare occurrences where on the micro chart it makes equal highs. Or actually no, sorry, this is actually not one of those situations yet. You can see here on the mini or micro chart, it makes equal highs and potentially might take you out there, right? Versus ES mini, where you don't get taken out at all. There's no equal highs here, right? And you're fine in this trade. 4.5, boom. So that's definitely something to keep in mind. There's another example right there. So far we've gone through like 4 examples of this occurring, and it's only been like 2 days. Here's one more right here, right? You can see, check the timestamp, 12:40 a.m. 12:40 a.m. right here. And you can see this wick right here at 12:57 a.m. stopped you out, while that wick was still right here on the mini chart. So if you're taking a short here, you would have been completely fine on the ES mini chart. But if you were shorting this on the micro chart, you would have got stopped out, even if you had your stop loss 1 tick above, right? See, you would have got stopped out either way. So I've never seen anyone make a YouTube video on this, so I thought this would be very interesting to make, since no one has ever covered such thing, because I'm guessing a lot of these people are just fake traders online, so they don't have actual experience like trading, so of course they don't notice these things. But these are things that I've noticed with my experience in the past trading micros, switching to minis, and just being able to see things that happened before that don't happen as much, right? So let's go back and see if we find another example here. Here's one more example right here. Boom, we made triple equal lows here on the mini chart. So if you're long here, again, my rule of thumb, try to potentially, or most try to, if you can, have your stop loss 1 more tick to give it breathing room. This would have been a fine TP right here on the mini. On the micro, look what happened here. You get stopped out by a tick, so you would have had to increase your stop loss by 2 ticks here to keep this trade going here. But other than that, you can see basically in terms of visually, there is a sweep right here that occurred, which did not occur on the mini chart, right? The mini chart 12:15 did not take that low out. It made equal lows, while this one took it out on the micro. And there's one more right here. Let's see. So right here, you can see this is completely fine on ES, right? You have a short right there that was perfect. And this in this situation right here, you didn't get taken out per se, but price did make equal highs here on the micro chart, while it did not make equal highs here on the mini. So you can see how the mini is less manipulated than the micro chart from all these examples. You can go, feel free to go back test this yourself. I'm telling you, this happens. So again, rule of thumb, increase your stop loss by 1 tick if you're on minis. If you're on micros, really just all depends on personal preference. Increase it by 2 ticks, or if you're fine with taking a loss, take a loss, but take the loss and know that there are still potential ways to re-enter, knowing that you are not necessarily wrong in your position. Because like this was a perfect trade. It just hit your stop loss early because you're on the micro chart. Here we made equal lows on ES. Here we took out the lows on MES. So on the micros we took it out. On the minis you're completely fine in this trade going long. So these are so many examples of this occurring that you'd be surprised how often it occurs, and people don't realize because they don't journal their trades like me. So here, another one. Obviously, if you have to increase your stop loss by 2 ticks to cover this one, and you probably did not do that. You probably keep it at the low like that. You got stopped out. Here again, you try to give it one spread. Even then, you would have got stopped out on the mini or the micro anyway. So that's another example. This is one of the rare occurrences, like I mentioned, where the mini or the micro does better than the mini chart. The micro chart here actually made equal lows here, not sweeping you out, while the mini chart actually did a sweep, a pretty solid sweep right there. So one of the rare situations here, but again, most times this does not occur, and the other way is more often true. So that's basically it for this video. We basically covered 1 week of worth of price action and seeing how many times these sweeps really occur. You see 1, 2, 3, 4, 5, 6, 7 occurred roughly 7, 1, 2, 3, 4, 5, 6, 7, 8. Okay, so roughly about, okay, we'll just say 8 times in a week. So that averages about, and it's not a week, this is from basically Monday. So about 5 days of price action. So you can expect this to happen on average of 1.5 or 1 time per day, right? On average. So again, if you were trading minis, you're safe really. Just increase your stop loss by 1 tick. Unless you know your broker doesn't take you out, then that's fine to keep it here. But for me, trade of 8 typically takes me out if there's equal lows like this. So I give it 1 tick of breathing room. And basically that's the end of this video today. I was just wanting to just do a quick batch testing session with you guys, show you guys this is a true thing that happens. Feel free to check this out on other assets as well to see what you find on Discover in terms of data collection and other assets. But again, quick video just going over how prevalent this really is and the reasoning behind why this occurs, why you find sometimes you get swept out early, and it's just due to this. You could do discrepancies between minis and micros. That could be one reason, due to these little discrepancies in price mainly. If you're getting your trade correct, sometimes this just does happen. That's the nature of the market. The market is not perfect, and it never will be perfect. And that's why there's inefficiencies we could take advantage of, which is AKA your strategy that delivers a positive edge over time. So that's it for today's video, going over this. At the end of the day, suggestions is, I'll list them out here. So you guys can get a general summary of today's video. To take away, if you can, trade just minis. Trade the mini chart, okay, if you can. Increase stop loss by 1 tick, preferably. And yeah, that's basically it. These are suggestions. If you can't, trade just minis. If you can't, stick with micros, but keep that in mind that your stop loss will get wicked out like that. And there's nothing much you could do aside from making your stop loss bigger. And if you're trading the minis, just increase your stop loss by 1 tick and see that how much that helps you with your win rate going forward. I'll see y'all in the next one.